So we focus most of our time debating whether this company has the right to survive and thrive in the environment and has the visibility it takes for the very long term. And we believe in markets like this, whether it's in 2020 when people were paying way too much for SaaS companies, or in a market like today where people are focusing very much on the near term, our focus on the medium to long term, we can find opportunities, and it remains the most attractive place to be for us.
Hello and welcome from Cologne. We're today at the FundView studio in Cologne, and with me is Justin Streeter from Comgest. Hello, nice to have you.
Hello, hi, nice to be here.
Yeah, we want to talk about US equities. Many investors shifted at the beginning of the year from US equities to European equities, but the trend kind of reversed. A lot of investors now looking again into US equities. In your view, what makes the kind of investment case for US equities at the moment? Because the valuations are pretty high, right?
Yeah, well, the US is an economy that's driven by the consumer, 70% of GDP. And so that remains the US miracle, where we hear it from our companies, whether it's Hilton, whether it's Visa. Yeah, you hear it from the likes of American Express or Costco. The US consumer continues to spend. Yes, the higher end consumer at top of the K is spending a little bit more in certain aspects, but overall, it's an attractive place to be. So the GDP is growing, and then with innovation, what we're seeing, especially in some of the infrastructure build out and some of the, I'm sure you'll have a question on the tech. There's a lot of innovation happening, so it's an exciting place to be right now.
Yeah, definitely, tech will be next. They are kind of the drivers of the market, the big tech companies. Do you, as an active investor, can kind of underweight them? Do you have a chance to underweight them because they're driving so much or having so much performance?
Yeah, so we. This year in 2026, there's about 2% of the stocks, so 10 stocks of the S&P that drive 70 to 80% of the returns, and that is a very narrow market. And as I mentioned, the U.S. is a broad market, so 70% of the market is consumer spend. So we are diversified by nature. We have about 30 to 40% exposure to the tech space, but if the tech space becomes 60 or 70%, we are likely to be a little underexposed to that space.
And your Comgest Growth America Fund is very broadly diversified, as you mentioned, but less stocks are driving the market right now. So do you see a high risk, this concentration?
The ideal scenario for us is that the majority of the stocks in our portfolio, 60%, carry their weight, outperform the market over the long term. So we look at 5 to 10 years on average. So things are more volatile in a shorter time period, but we're looking for companies that can compound over 5, 10 years, whether that's with Costco's value for money delivery to their services, whether it's card payments making daily life easier for people, or Eli Lilly offering better obesity, diabetes management. So tech is one exciting space, but there's a lot of growth drivers in the US that are very exciting, which offer customers and the healthcare system or the government ways of doing more with less. So that's really the theme for our portfolio: productivity gains and helping people and customers do more with less, have a better solution for less money.
And every investor is kind of focusing growth. Every stock have to grow, but quality stocks do have a lot of headwind at the last couple of months or even years. Do you see like a comeback from quality stocks, and what could drive this comeback?
Yeah, I think if we look 5 or 6 years ago in 2020, when there was free money, people were willing to look at like 50 years ahead, 100 years ahead for payback. If you think of some of these unprofitable SaaS companies that we didn't really invest in. And today, it's a little bit the reverse. They're afraid of innovation, which could change in 5 or 10 years. And so they want cash flow today. So some of these semiconductor chip companies get cash flow today, and you don't have to think about what happens in 5 or 10 years. We continue to believe that the most attractive companies are the ones that can grow over double digits for a long period of time. So some of the companies that we have had in a portfolio for almost 20 years, they continue to grow over 10% every year. And those are the kind of companies that we look for, where you have high visibility for a long longevity. To us, that's quality, is visibility. So we focus most of our time debating whether this company has the right to survive and thrive in the environment, and has the visibility it takes for the very long term. And we believe in a market like this, whether it's in 2020 when people were paying way too much for SaaS companies, or in a market like today where people are focusing very much on the near term, our focus on the medium to long term, we can find opportunities, and it remains the most attractive place to be for us.
So positive generally for US stocks and generally also for quality stocks in the US is Justin Streeter from Comgest. Thank you very much.
Thank you very much.